Look, I need to tell you something that's happening right now in the precious metals market. And if you own physical gold or silver, you need to hear this before you make a decision you'll regret for the rest of your life. There's a massive push happening right now to get people who own physical metal to trade it in for paper contracts, ETFs, mining stocks, anything but the actual metal itself. And I'm going to show you exactly why this is one of the most dangerous financial moves you could possibly make at this exact moment in history. Let me start with what's actually happening behind the scenes, because the mainstream financial media isn't going to tell you this story. They can't. There are too many powerful interests that need you to stay in the dark about what's really going on. Right now, there's a structural problem in the precious metals market that's so severe, so potentially catastrophic, that if the general public understood the full scope of it, there would be an immediate run on physical metal that would make the bank runs of the Great Depression look like a minor inconvenience. Here's the reality. For every ounce of physical gold that actually exists in vaults, there are somewhere between 100 and 250 paper claims on that same ounce. Think about that for a second. If you own a paper gold contract, an ETF share, or a certificate claiming you own gold, there's a very real possibility that your claim is one of hundreds of claims on the exact same bar of metal. This isn't conspiracy theory. This is how the system is designed to work. It's called fractional reserve precious metals banking, and it's been the standard operating procedure for decades. The entire structure depends on one critical assumption, that not everyone will want their physical metal at the same time. But what happens when that assumption breaks down? We're starting to see the cracks. Major bullion dealers are reporting delivery delays that they've never seen before. Premiums on physical metal over the spot price have exploded to levels that make no sense if there's actually plenty of metal available. The spread between paper prices and physical prices is widening in ways that signal serious stress in the system. Let me tell you about something that happened recently that should terrify anyone holding paper gold. A major institutional investor, we're talking hundreds of millions of dollars, tried to take delivery of physical gold from their COMEX contracts. Standard procedure, right? They own the contracts, they want the metal, they should get the metal. Instead, they were offered a cash settlement at a premium. Then when they refused, they were told there would be significant delays. Then the delays got longer. Then they were pressured again to take cash instead. This went on for months. Eventually, they got their metal, but the process revealed something crucial. The system is not designed for people to actually take delivery. It's designed to keep metal in paper form, circulating as contracts and claims, never actually moving into private hands. Now multiply that story by thousands of investors, and you start to understand the scale of the problem. The physical metal market is tiny compared to the paper market. Global gold production is around 3,000 tons per year. Sounds like a lot, right? But the paper gold market trades that much volume in a matter of days. The entire annual production of gold gets traded on paper markets in less than a week. This creates a massive vulnerability. If even a small percentage of paper gold holders decide they want physical delivery, the system simply cannot handle it. There isn't enough metal. There never was. And here's where it gets really interesting. Central banks know this. They've known it for years. That's why they've been accumulating physical gold at record pace while simultaneously managing the paper markets to keep prices suppressed. They're playing both sides of the game, and they're doing it because they understand something that most retail investors don't. When the system breaks, paper claims will be worth exactly what they're printed on. Nothing. Look at what happened in 1971. Nixon closed the gold window because foreign central banks were demanding physical gold for their dollars, and the United States didn't have enough gold to meet those demands. We had issued far more paper claims on gold than we had actual gold in Fort Knox. So rather than admit the system was broken, we just changed the rules. We said gold was no longer money, and everyone had to accept paper dollars instead. That worked for a while. But now we're seeing the same pattern repeat on a much larger scale. Countries around the world are demanding physical gold. They're not interested in paper claims anymore. They want the actual metal in their own vaults, under their own control. China has been accumulating thousands of tons of gold. Russia has been converting dollar reserves into gold. India, Turkey, Poland, Hungary, the list goes on. Central banks globally have been net buyers of gold for over a decade now, and the pace of accumulation is accelerating. Why? Because they know what's coming. They understand that the paper system is built on a foundation of promises that cannot all be kept simultaneously. They're getting out of paper and into physical while they still can. And here's what should really concern you. While central banks are buying physical gold, retail investors are being pushed into paper alternatives. ETFs, mining stocks, futures contracts, all the paper derivatives that give you exposure to gold prices without actually giving you the metal itself. The pitch sounds reasonable. Paper gold is more convenient. You don't have to worry about storage or security. You can trade it instantly. You get the same price exposure without the hassle of dealing with physical metal. But that convenience comes with a catastrophic risk that most people don't understand until it's too late. When the system is under stress, when there's a real crisis, paper gold and physical gold become two completely different assets with two completely different values. Let me give you a historical example. In 1933, President Roosevelt issued Executive Order 6102, which required all American citizens to turn in their gold to the government at a fixed price of around $20 per ounce. If you refused, you faced up to 10 years in prison and massive fines. After the government had collected all the gold from private citizens, they revalued it to $35 per ounce. The people who held paper claims got $20. The government, which now held the physical metal, valued it at $35. That's a 75% gain that went to the government, not to the people who actually owned the gold. Now, I'm not saying that exact scenario will happen again, but I am saying that when governments and central banks need to reset the financial system, they will protect physical metal holders differently than paper claim holders. History shows us this pattern over and over again. Here's another angle most people miss. The paper gold market is dominated by a small number of large banks. These banks are both the market makers and the largest participants. They set the prices, they execute the trades, and they hold massive short positions in gold. This creates an inherent conflict of interest. These banks profit when gold prices stay low or decline. They lose money when gold prices rise significantly. So, what do you think happens when there's a surge in demand for physical gold? These banks have every incentive to suppress the paper price to protect their short positions, even as the physical market is showing extreme tightness and rising premiums. This is why you can see situations where paper gold is trading at one price, but if you actually try to buy physical metal, you're paying significantly more. The paper market and the physical market are disconnecting. And this disconnection is accelerating. Silver is showing this even more dramatically than gold. The paper silver market is showing one price, but try to buy 1,000-ounce bars for immediate delivery, and you'll find that the real price is substantially higher. Dealers are running low on inventory. Mints are rationing production. Industrial users are securing long-term supply contracts because they're worried about availability. This is not normal market behavior. This is what happens when the paper market is losing its ability to represent the physical market. The paper price becomes increasingly fictional, while the real price, the price you actually have to pay to get metal in your hands, tells a completely different story. Now, let me address something important here because I know some of you are sitting on retirement accounts, and you're thinking about how to protect your wealth in this environment. If you've got $100,000 or more in traditional retirement accounts, there's actually a way to get physical gold into those accounts without triggering taxes or penalties. I put together a free guide that walks through exactly how gold IRAs work, what the rules are, and how to set one up properly. You'll find that in the description below. It's worth looking at if you're serious about holding physical metal as part of your retirement strategy. But here's what you need to understand about the difference between physical metal in your possession and any kind of paper claim, including ETFs and retirement accounts. Physical metal that you hold directly is an asset that exists outside the banking system. It's not someone else's liability. It's not dependent on any institution remaining solvent. It's not subject to rehypothecation or fractional reserve practices. It's yours, completely and totally. Paper gold, on the other hand, is always someone else's promise. It's a claim on metal that may or may not actually exist. It's dependent on the solvency and honesty of the institution that issued it. And in a real crisis, those promises have a history of not being kept. Think about what happened in 2008. Lehman Brothers had all kinds of paper assets on their books. They had contracts, derivatives, claims on various assets. When they collapsed, what happened to all those paper claims? They became worth pennies on the dollar, if anything. The people who held physical assets, real estate, actual commodities, they still had something of value. The people who held paper claims on those assets found out that paper burns very easily. Now imagine that scenario playing out in the precious metals market. You own shares in a gold ETF. The ETF is supposed to hold physical gold in a vault somewhere. But what if that gold has been leased out? What if it's been used as collateral for multiple loans? What if the custodian bank that's supposed to be holding it goes bankrupt? What happens to your shares then? The prospectus of most gold ETFs includes language that basically says, in a crisis, they might settle your shares in cash rather than metal. They might not be able to deliver physical gold even if you want it. They reserve the right to change the rules when things get difficult. Read the fine print. It's all in there. They're telling you up front that your paper claim might not be convertible to physical metal when you actually need it to be. This is why the push to get people out of physical metal and into paper alternatives is so insidious. It's not about convenience. It's about maintaining control over a system that's fundamentally unstable. As long as most gold is held in paper form, the banks and governments can manage the market. They can suppress prices when they need to. They can create the illusion of abundant supply. They can prevent the kind of price discovery that would reveal the true scarcity of physical metal. But when people hold physical metal directly, that control breaks down. Physical metal can't be printed. It can't be created with a keystroke. It can't be rehypothecated or leased or used as collateral for multiple claims. It just sits there, outside the system, representing real wealth that can't be inflated away or confiscated with the click of a mouse. This is why, throughout history, during every major financial crisis, governments have tried to get control of physical gold. They need to control it because it represents an alternative to their paper currency system. It represents a form of wealth that they can't manipulate or devalue at will. And right now, we're heading into a period where that control is going to become increasingly important to them. The debt levels globally are unsustainable. The United States alone has over $36 trillion in official debt, with unfunded liabilities that push the real number into the hundreds of trillions. There's no mathematical way to pay this back with sound money. The only way out is inflation, currency devaluation, and financial repression. In that environment, physical gold becomes incredibly valuable because it's one of the few assets that maintains purchasing power through currency crises. But paper gold? Paper gold is just another form of currency, another promise from the same system that's creating the crisis in the first place. Let me tell you about what's happening in the silver market right now, because it's even more extreme than gold. Silver has massive industrial demand. It's used in solar panels, electronics, electric vehicles, medical applications, the list goes on. Industrial users need physical silver. They can't use paper contracts to manufacture products. They need the actual metal. And right now, industrial users are panicking. They're seeing the same supply constraints that investors are seeing, but for them it's not about investment returns. It's about whether they can keep their factories running. So they're locking in long-term supply contracts. They're building inventory. They're doing whatever they can to secure physical metal. This industrial demand is competing with investment demand, and the total available supply is not growing fast enough to meet both. Mine production is relatively flat. Recycling can only provide so much. And the above-ground stockpiles that used to act as a buffer are being drawn down. What does this mean? It means the paper-silver market is even more disconnected from reality than the paper-gold market. The COMEX silver inventories have been declining. The spreads between paper and physical prices have been widening. And yet the paper market keeps trading as if there's unlimited supply available. This can't continue indefinitely. At some point, the physical market will overwhelm the paper market. The real price, the price you have to pay to get actual metal, will diverge so far from the paper price that the paper market loses all credibility. And when that happens, anyone holding paper claims is going to find out very quickly that they don't actually own silver. They own a promise that can't be kept. Now here's what makes this moment in history so critical. We're not just dealing with normal market dynamics. We're dealing with a fundamental shift in the global monetary system. The dollar's role as the world reserve currency is being challenged in ways it hasn't been since World War II. Countries are conducting trade in their own currencies, bypassing the dollar entirely. They're creating alternative payment systems that don't rely on Western banks. They're accumulating gold as a neutral reserve asset that doesn't carry the political risk of holding another country's currency. This is a massive historic shift, and it's happening right now. The implications for precious metals are enormous. As the dollar's dominance fades, as trust in paper currencies declines, physical gold and silver become increasingly important as stores of value and mediums of exchange. But here's the key point. This transition benefits physical metal holders, not paper claim holders. When the system resets, when currencies are revalued, when new monetary arrangements are established. The people holding physical metal will have real assets to bring to the table. The people holding paper claims will have to hope that the institutions that issued those claims are still solvent and willing to honor them. History suggests that hope is often misplaced. In every major monetary transition, paper claims have been devalued, defaulted on, or settled in depreciated currency. Physical assets, on the other hand, maintain their value through the transition. They represent real wealth that survives the reset. This is why I'm telling you, if you own physical metal right now, do not trade it for paper. I don't care how convenient paper seems. I don't care if someone offers you a premium to convert. I don't care if the paper market is showing better liquidity or lower transaction costs. None of that matters when the system is under stress. What matters is whether you own a real asset or a promise. What matters is whether your wealth is inside the banking system or outside it. What matters is whether you're dependent on institutions remaining solvent or whether you hold something of value regardless of what happens to those institutions. And right now, at this moment in history, that distinction is more important than it's been in decades. We're not in normal times. We're in the late stages of a debt supercycle. We're watching the global monetary system undergo a fundamental transformation. We're seeing supply chains break down, geopolitical tensions rise, and trust in institutions decline. In this environment, physical metal is not just an investment, it's insurance. It's a form of wealth that has survived every crisis, every currency collapse, every monetary reset in human history. It's what people turn to when everything else fails. Paper, gold, and silver, on the other hand, are products of the current system. They exist because the system needs them to exist. They function because the system allows them to function. But when the system itself is in question, those paper products become questionable too. Think about it this way. If you owned a claim on a house, a piece of paper that said you had the right to live in a specific house, but someone else actually held the deed and lived in the house, how secure would you feel about your claim? What if there were 100 other people who also had claims on that same house? Would you feel confident that your claim would be honored when everyone showed up demanding their house? That's essentially what the paper precious metals market is. It's a system of claims on metal that may or may not actually be available when those claims are exercised. And the more people who hold claims, the less likely it is that everyone will get their metal. The smart money understands this. That's why central banks are accumulating physical gold, not paper gold. That's why wealthy families have been moving assets into physical precious metals stored in private vaults. That's why institutional investors who understand the system are taking delivery of physical metal rather than holding contracts. They're not doing this because they're paranoid. They're doing it because they understand how the system works, and they understand what happens when the system breaks. They've seen it before. They've studied history. They know that paper claims are only as good as the institutions that issue them, and they know that institutions fail. So when someone tells you to trade your physical metal for paper, ask yourself, why? Why would they want you to give up a real asset for a promise? Why would they want you to move your wealth back inside the system when the system is showing signs of stress? Why would they want you to become dependent on institutions remaining solvent when those institutions are carrying unprecedented levels of risk? The answer is usually pretty simple. They benefit from you holding paper rather than physical. Maybe they're a bank that needs to manage their short positions. Maybe they're a government that wants to maintain control over the gold market. Maybe they're a financial institution that makes money from managing paper assets. Whatever the reason, their interests are not aligned with yours. Your interest is in preserving your wealth through whatever comes next. And history is very clear about what preserves wealth through monetary crises. Physical assets, particularly precious metals, held outside the banking system, under your direct control. This doesn't mean you should never hold any paper assets. It doesn't mean every ETF is going to zero or every mining stock is worthless. But it does mean that your core precious metals holdings, the wealth you're counting on to survive a real crisis, should be in physical form. It should be metal you can hold, metal you control, metal that exists independent of any institution's solvency. And if you already own physical metal, if you've already made the smart decision to hold real assets, then for God's sake, don't let anyone talk you into trading it for paper. Don't fall for the convenience argument. Don't fall for the liquidity argument. Don't fall for any argument that involves giving up something real for something that's just a promise. Because when this system finally breaks, when the paper market disconnects completely from the physical market, When the promises can't be kept and the claims can't be honored, you're going to be very glad you held on to the real thing. You're going to be glad you didn't trade your metal for paper. You're going to be glad you understood the difference between owning an asset and owning a claim on an asset. The people who don't understand that difference are going to learn a very expensive lesson. They're going to find out that paper burns, that promises break, and that when the system is under real stress, the only thing that matters is what you actually own, not what someone promised you could have. So hold your metal. Keep it close, keep it secure, and whatever you do, don't trade it for paper. Not now. Not when we're this close to a major monetary reset. Not when the signs of system stress are this obvious. Not when the smart money is doing exactly the opposite of what the mainstream financial system is telling you to do. Your physical metal is your insurance policy against everything that's coming. It's your wealth preservation in a world of currency debasement. It's your financial independence in a system designed to keep you dependent. Don't give that up for the illusion of convenience or the promise of paper profits. Hold the metal. That's the message. That's what matters. Everything else is just noise designed to separate you from real wealth and keep you trapped in a system that's running on borrowed time.